I'm Morella Fernandez. Thanks for joining us today on Market Call. Paul Harris with us on the show, partner and portfolio manager at Harris Douglas Asset Management. He'll take your questions today on North American and global stocks. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. Market Call at bnnbloomberg.ca if you want to send an email. Paul, good to see you. Thanks for joining us today.
My pleasure.
It has been a dramatic week, of course, on the North American markets. Can you go through the opportunities you're seeing and what is going on?
Well, so I think from my perspective about this is that it's kind of when there's chaos like this, there's always opportunity. And I think the stock market, if you look at it over a year, there's always these opportunities where the market falls for many reasons. And we know what the reason is now, but it falls. And so if you as an investor really like a certain kind of business or like a certain company, then this is always kind of these opportunities to buy these companies cheaply from a price basis. And I think valuation and a valuation basis as well, because maybe you don't feel that the earnings will be affected by the events that are happening presently, and that gives you this great opportunity. So in that, I think that chaos, there's opportunity for people who really want to buy businesses, right? And I think that it's obviously a difficult thing to do, don't get me wrong, because the stocks are falling precipitously. But I do think that if you know the company, if you've done your work on it, these are the great times to look at these businesses and be able to purchase them at which I think prices you may not see again for a while.
Why do you think that the TSX is being hit harder, it seems, than the markets in the U.S.?
Well, I mean, I guess one reason is that the TSX went up a lot last year and was up a lot at the beginning of this year. So that's one thing. I mean, I think also, some of those stocks in the TSX, although there's some great companies there, some of the valuations are, at a very high level. So that creates some volatility as well. And, obviously there's gold and resources and all these other businesses that have really done well over the last several, a year and a half, 2 years. And so I think those are the stocks that are slowly getting beaten down. But I think that that's one of the reasons. I mean, it is kind of a weird time in the markets because in this kind of volatility what happens when you see these things happen, usually two things happen. One, the US dollar strengthens, which is not really happening, and US debt gets interest rates go down a lot, right? But that's really not happening, which so tells you there's a different scenario that's going on at this present time. The other thing I think that people need to look at is the volatility in the VIX index, which is a measure of risk, but it's only at 25, and I think you really need it to be much higher in order for people to capitulate, say, I'm out of the stock market, and I think that's when you get a chance to buy. Now, like I said before, it's great to buy these companies, but you may have to suffer them going down some more from where you are right now.
Okay, oil has had a boost, as you know. Would you chase oil where it is today?
No. I mean, I think that this is I think when you've seen these things happen, especially within the oil side, once things settle down, oil starts to fall back very quickly. Right.
Okay.
So I think you got to be careful about buying those companies at these level, right now, because I think oil will easily come back to where it was prior to this happening, and maybe stay a little bit higher. But it may stay higher for longer here because of this particular thing looks like it may go on for longer. But the reality is that once you have some kind of settlement or some kind of discussions with Iran, I think oil prices will start to fall back down again. And I think that's a very kind of dangerous thing to be doing, buying oil stocks, given that oil's running up. Because in reality, there's lots of oil around, right? I mean, that's been the problem for oil in the last little while. Has been that there's lots of oil, and so and prices have been depressed because of that. Not depressed maybe, but at a much lower level than it is today. And part of this move is really just been the fact that what's going on with Iran and in the Middle East.
Okay, let's get quickly to the American job numbers, which came out today, a drop for them. How are you interpreting this?
Well, I think if you look at the job numbers, they've been very bad because even in 2025, they were bad. I think people kept on saying they were good because they look at the headline number and they were higher, but then they're always revised down, right? So I think between December and January, they were down almost 50,000 or 71,000 or something like that. And if you look at it over the whole year in 2025, job growth has been negative. So I think people tend to look at the headline numbers, and in this case it was a bad number in the headline number because people were calling for plus 55,000 and it was down. So, but I think that as a general rule, that there's been lower job growth, which people have just kind of put aside, right, and said, oh, there's the job market stabilizing. It's not stabilizing, right? The job market is gotten worse, and I think and that's one of the reasons why the bond market is done well, a little bit better today, because the fact that people feel that rates may come down because of that. But I think that that's kind of the issue. The job market is not, and that was quite broadly based. So you saw losses in jobs in banks, you saw it in construction and in manufacturing, you saw it in leisure and hospitality. I think healthcare was the only one, but and there was another area that saw job losses. So I think that the job market is not strong, and people have kind of said, "Oh, it's stabilizing." It's not stabilizing, and I think even the Fed said that, right? The more job market is stabilizing, it's not stabilizing. I think there's a lot more, and this may be the kind of the nascent beginnings of what AI is doing to the job market. I don't know, but you've seen productivity numbers that are better as well, so that may be helping it. So I think there is these underlining issues that are going to face the job market over the next several years.
All right, I'm going to leave it there, Paul. Let's get some phone calls lined up for you. Paul Harris of Harris Douglas Asset Management, taking your questions today on North American and global stocks. Back in a moment. Welcome back to Market Call. Let's start with an email from Peter. He has a question for Paul Harris today. He says, should I sell my shares of CNQ? Paul, we were talking about oil and whether or not you would chase it. On the flip side, would you sell? They've had, I think, a $20 increase more recently, benefiting from what's going on in Iran. Would you trim or sell CNQ at this point?
So certainly, I wouldn't do that. I mean, CNQ is one of the best oil companies in this country. I think it's shown to be, had great management. They've been very good acquirers over the long term of buying assets when they become cheap. They've actually, when you look at any of the projects that they've worked on, they are consistently coming right on the cost side. So I think that it's a really well-run company. I think if you have a large position in it, I would trim it, of course, because you've seen kind of oil do what it's done. But I think you want to hold on to this company. And I think one of the things that these companies have done, sort of the larger cap oil companies have done very well, is because they went through a very difficult period. They they kind of buy back their shares, they pay down their debt, they increase their dividend. They've got great free cash flow. So I think they're well-run businesses today, and I think that over the long term, it'll continue to do well. So we own it. We've liked it for a long time, but maybe if it's a very large position for this gentleman, I think it's a gentleman, I would probably maybe trim a bit of it and hope to maybe buy it back if oil, like I mentioned earlier, if oil pulls back, and so you can actually buy it back cheaper. But it's not something that I would do. I think these are great. This is a great business, great, well-run Canadian oil company.
All right, yeah, it was for Peter. So let's move on then to John in Milford, Ontario. He's on the phone line. Hi, John.
Hi. Good afternoon. Paul, I'd like your opinion on Algonquin Power. I don't own it, but I'm a dividend investor, and I'd like to own it for the long term, and I don't mind averaging down. What's your thoughts going forward, and what's the dividend on it? Thank you very much.
Okay,
Bye.
I'll have a look at the dividend in a second, Paul. Algonquin Power does renewables. Is this a company you'd put some money in?
No, well, no. I mean, we owned Brookfield Renewable, but I mean, I think that Algonquin's had a lot of issues over the years. They've kind of overexpanded too quickly, and they got hurt by that. They took on way too much debt, so they were in a restructuring phase, I think, more than anything else. Although, when they had to cut their dividend, and I think they did something very classic as a management team. They just kept on refusing to cut their dividend, the board even, when things got bad, and that's what they should have done first of all. And so the stock has collapsed after that. But I think that it is on a big restructuring phase still, and I think that there's better companies to own than that if you want dividend payers, especially if you want something like the banks, et cetera. There are better dividend payers than Algonquin. I think there's a lot of things that have to be done there still. So I would avoid something like that. My view is that there are better companies to own.
Okay, just for his information, 4.3 is where the dividend is at for Algonquin Power. Let's go to Nicole in Montreal with a question. Hi, Nicole.
Hi, and happy TGIF to you both. Paul, I'm disappointed. No bow tie today, but that's okay. Just wanted to know your opinion on Netflix. I've owned it for quite a while. Looking forward to what you expect looking forward. Thanks. Have a great day and take care.
Thank you for the question. Netflix, as you know, Paul, got a bump after bowing out of the Warner Brothers bid.
Right. So, I think one of the issues for Netflix is that owning, part of what's core to obviously streaming is content, and having a Warner Brothers backlog of a catalog rather of whether it's Godfather, et cetera, would have made a big difference to them. But I think that the reality is that the price that Paramount or Skydance, that company paid, was very high, and it's going to be very difficult. They're going to have to cut a lot of costs out of it, and I think that's a very much more difficult thing. But I think Netflix did the right thing. They wanted to own it. They made the best bid they possibly could without destroying their balance sheet and all these other things. And when they realized that's not going to happen, they pulled away. They ended up getting, I think it's $2 billion because of the breakup fee. But I think that they can continue on. They're still the largest streamer in the world. I think they create their own content. They can still actually buy content from all over the place. So I think Netflix is in a better situation in some ways because they didn't pay up to buy something that would have cost them a lot of money, put a lot of debt on their balance sheet. So I think they will, I think the streaming business is where things are going. Netflix obviously does a lot of other things. They can now, you can see them where they do podcasts on their shows and all these other things. So Netflix has a great business that continues to grow. I think that they will continue to be one of the top leaders in streaming, and I think other people are still going to have to try to catch up. And I think Paramount is going to have to do a lot of work to make that acquisition work, paying what they pay, which is $111 billion, I think.
Got it. All right. Let's move on then to Chris on the line in Delta, BC. Hi, Chris.
Oh, good morning, Marilla and Paul. Thank you for taking the call. Paul, I know I've done quite well on your recommendations in the U.S. banks, specifically Bank of America. Unfortunately, I've long since sold out of it, and the run that they've had overall has been incredible. They've retraced slightly lately, but really not much in the grand scheme. And so I'm wondering, as a 30-year-old long-term investor, would this be a price point that for the group or a specific security within the group that you would purchase as a full position now, or would you sort of maybe do it in thirds? And what those thirds might look like 10% lower from here, et cetera. Thank you so much. I'll hang up and listen.
Thanks for the question, Chris. Paul, go ahead.
Great. So, we own Bank of America. We continue to own it. I think it's, certainly has more value upside from here. I think that the issue with U.S. banks is it's important to understand what's going on there. One is that there's kind of this deregulation that's going on in the United States on the banking side, which really, outside of capping credit cards, so that there's just a general deregulation, which means that they have to hold less capital when they're doing certain things. So that's really important for the banking sector. And so they can, it's good and it's bad. Good because they can reallocate those capital to other businesses. The bad part, obviously, is that sometimes they end up doing stupid things with it. But let's hope they, Brian, the gentleman who runs Bank of America went through 2008, so I think he would recognize the fact that it's you have to be very careful. That's one thing. The other thing that's happening, I think, in banking, which is much more, and we don't own these companies, but the regional banks, the administration is much more amenable to doing bank acquisitions, and you've seen a bunch of them over the last little while, and I think that will continue to happen. The consolidation of the U.S. banking industry will take place, I think, in this next couple of years. So I think that gives you an opportunity to buy sort of more regional banks if you so incline that way. The other thing that I think is helping banks outside of the kind of retail business and the credit card and the asset management business is most of these banks, money center banks like Citibank and Bank of America and JP Morgan have huge capital markets businesses, and this kind of volatility is great for them. Like, I mean, they make tons of money on volatility like this, so they should have very good numbers in the first quarter based on the volatility, or if the volatility continues. So I like banks. I think there's a lot of things many things that are happening in the banking industry in the United States that allows them to allocate capital better. Also, because they have more capital, they can buy back more shares. They can increase their dividends. So there's a lot of good things happening in banking. So I think that owning Bank of America here, owning some of the Goldman Sachs, Morgan Stanley, those kind of people will do very well because of the volatility. Looking at a regional bank or regional bank index, if you want to, would be very, very good, because I think those regional banks will consolidate over the next couple of years.
Got it. All right, Chris, I hope that helps you out. Let's take a quick break. Back with Paul Harris of Harris Douglas Asset Management in just a moment. Stay tuned. Welcome back to Market Call. Let's go to Jacob on the line in Toronto. He's got a question today for Paul Harris. Hi, Jacob.
Hello, good afternoon to you both. And I'd like to ask your guest, please, about the Brookfield Corporation. I'm holding a big chunk of it, whether to sell it or just trim it. Thank you very much and have a nice weekend.
Thank you for the question. Paul, I know you mentioned Brookfield Renewables. Are you in to Brookfield Corporation at all? What do you think of it?
Yeah, so we own Brookfield Corp, which is the main holding company for a lot of the other businesses that they own. I think, I wouldn't not tell it. I think Brookfield's a great company. It's incredibly well run. But this is like this kind of volatility for Brookfield. Like if it continues, this is the kind of environment that they thrive in, right? Because they are able to pick up cheap assets at this time because of the volatility, and if things stay down here, if there's things that they're on their kind of list that they're looking at, they can do a lot of deals. They have lots of capital. They've raised lots of money, so they have a lot of money to put to work. I think Brookfield is a unique Canadian company that's has the ability to kind of still grow quite rapidly over the next several years. Because you hold the holding company, sometimes it trades at a discount to its NAV, so you have to kind of be wary of that. But as a general rule, I think Brookfield is a great business in this country. They have the capital to go out and globally, like they're just a global company with the ability to put funds anywhere in the world, and they have lots of people that invest alongside with them, sovereign funds, etc. So I think that they are smart operators. This kind of volatility, as a general rule, helps them because they can make acquisitions of certain assets that become cheap. Okay.
Hope that works for him. Let's go to David in Toronto with a question. Hi, David.
Hi. My question is about the Intact Financial. Is it time now to buy it or sell it?
Okay. Thank you for the question. Let's have a look at Intact, pulling it up now. Dave, what do you think, Paul?
Yeah, well, so Intact is a insurance company in Canada. I think it's done, sort of has had, it really sort of ran up a lot and it's pulled back a little bit. I think that this is a great business. They actually really understand the property and casualty businesses, which is property and sort of they do car insurance and all those other things like that. So that it's a great business. They get to reprice very easily, unlike the life insurance business, which you can't reprice as quickly. So they get to reprice very easily. So that's one of the things that's really helped them. So I think that it's a great business in Canada. I think one of the problems is that it's harder for them to I think they've did a few acquisitions and things like that, but that's harder, I think, for them to do that now because they've gotten so big. But I think it's a premier company in this country. And they execute very well, and I think that's worth owning here.
Okay, that was for David. Let's go to Maurice in Vancouver with a question. Hi, Maurice.
Hey there. I had a question about Cenovus Energy with their recent acquisition of Mega Energy. How do you feel about a long-term hold with that one?
Okay, let's talk about energy widely. It's been up, so it's up to $31.94, up 80% over the last year. Paul, would you put new money into Cenovus at this point?
We own C&Q, we don't own Cenovus. So I think that, I think they're like Cenovus C&Q, Suncor have been a great, like over the so Novus actually was not as good as business as those other two for a while because it was a split off of in Canada, and so they went through a lot of issues and stuff like that. But I mean, I prefer to own C&Q. I think it's a better company, it's better run. But I think if you're in Cenovus and they've done this deal, I think that over the long term, if they continue to execute well and merge the companies well and all those other things, I think that's the risk a little bit. But I think if they can do that well, I think you'll be fine. I think if they continue to pay down debt and do all the things I think that a good company does, I think it's fine. I think the issue is when they sometimes end up being too aggressive and making acquisitions that are too costly, et cetera. And that's what I liked about C&Q. And Suncor as well has done this, right? But they've made acquisitions in bad times in oil, and that's helped them integrate better, get better costs out of the system, all that stuff. So I prefer to stay with C&Q, but Cenovus is shown to do a better job lately than it did several years ago.
Do you think it overpaid for MEG?
No, I don't know if they overpaid. I mean, I guess they had a bit of a battle for it, but maybe I guess it's one thing to overpay for something is just how do you integrate that into the business, right? Maybe you could take all the costs out, and maybe they were, I think that's what you have to be careful about is that when they paid so much for a company, you may not see the synergies as quickly. You may not be able to do all those things unless you're highly aggressive, right? And so I think that you want to make sure that they're executing on what they say, and if they do that, I think it'll be fine. But if they don't, you end up with this kind of same situation you did before with them, where they're just kind of floundering, right? And I think that C&Q or Suncor has done better at when they made acquisitions.
Okay. Maurice, I hope that works for you. Let's go to Sam. He's on the line in Ottawa. Hi, Sam.
Hello, good afternoon. Thank you so much for taking my call. Just a question regarding Royal Bank. I recently started a position. It's just been beat up, right up because of what's happening, outside in Middle East, whatever. And I feel like it's almost, what I mean? It's a great bank, in my opinion, and their cost is to run the bank is continuously dropping thanks to AI. And with immigration is still going to be coming in here in Canada, I think they'll do well. Do you have any opinion? Do you think it's a good buy right now? Because I just bought some today. Thank you so much.
Okay, I like that he asked after the fact. Okay, let's go to Paul on that.
Right.
Where do you stand on financials in Canada? I mean, I know they're always tend to be a solid buy.
Yeah. So we own Royal. It's one of our bigger positions, and we've owned it for a long time. So firstly, I mean, banks had an incredible run last year. So them pulling back a little bit from here, I don't think is kind of, it's not the end of the world. And I think that's what happens with good businesses. They sometimes pull back and you have this thing. So, as I spoke to you earlier on, there was in chaos there's opportunity. Sometimes Canadian banks get treated like they're American banks. And they're not, right? We're not. We are very different. We're highly regulated. We're a very different animal altogether. I think what helps the Royal, I think one of the problems when you look at the numbers for the banks in general over the last quarter, you saw kind of revenue, revenue go up, but costs go up equally. So that's not a good scenario. They need to cut costs further, number one. Number two, you didn't see a lot of kind of loan growth as a general rule. So I think that's, if you want to see them hit their ROE targets, which they've mentioned, I think you're going to have to see better loan growth. I think where Royal can, two areas that Royal will do really well is obviously the asset management business, which they're quite large in, and the other thing is capital markets. And so, like I mentioned earlier on, the volatility in the stock market will lead to, I think, better returns on capital markets for them. I think if the market stabilizes, there's lots of opportunity for IPOs and M&A going on, even in Canada and the United States, which Royal will be involved in. So I think that will help the Royal as well, and that's kind of the variable that that you will see in their earnings numbers. If everything else assumes some stability, you can get a lot of variability because of the asset management business and also because of the capital markets business, which Royal is quite large in.
Okay. Let's leave the block there. We will take another quick break, but we'll go through Paul's past picks when we come back. Welcome Welcome back. Time to go through past picks from Paul. These are from February 24th, 2025, so just over a year ago. Paul, at the time you chose Alphabet Google on the NASDAQ, it was at the time 181.19 US, now to 297.08, 64% upside for both return and total return. Clearly, that case in the US that didn't end up being a big deal for Alphabet brought investors some relief. Are you staying invested in it? Have you trimmed it all with the increase in the share price?
No, we still own it. We still own our position in it. So I think you're right that the lawsuit helped them. I think what hurt this company most of the beginning part of last year is I think that there was a big feeling that two things were going to happen. One, their research business was going to go away because of ChatGPT, which didn't happen, of course. And the other thing was, which was more, I think, far more important than even the lawsuit, was the fact that they were. There was this impression that they were so far behind someone like ChatGPT on AI, and both those things really didn't happen. So, Gemini is doing just as well as ChatGPT. So they had this kind of this resurgence of people realizing that, oh, they're not going to be lost in all this stuff. So that's one thing. I mean, search is still pretty strong for them and continues to be strong. The fact that they have a cloud business that kind of continues to grow. Although they were kind of late to cloud relative to Microsoft and AWS, they're definitely the third largest player in cloud in the world. So that's really kind of a business that protects them to a certain degree with all this AI spend. And the last thing I think is something like Waymo, which is a great, which they just kind of did a funding round in, which is, I can't remember the numbers, but they've done very well with that. And, it's a self-driving car. And you look at someone like Tesla who comes out and talks about, robo-taxi or whatever. Well, I mean, they're in Austin. I mean, big deal. These guys are so many parts of the United States, whether it's LA, San Francisco, Phoenix. They're going to be in New York. They're going to be in Washington. So maybe not in New York, but in Washington D.C. and a bunch of other in Austin. They're in Austin as well. So they've got far more data. They've done this for much longer. More and more people using their stuff. So you've got this asset that's kind of undervalued in my view. So I think that they've got 3 or 4 businesses that YouTube continues to do well. In fact, I would think that when this Warner Brothers deal was going through, most people looked at Netflix and said their biggest competitor is YouTube, and it truly is, right? So I think they've got a bunch of businesses that are doing very well. Advertising continues to do well, digital advertising. So I think that's a great company to own.
Okay, let's get to your next past pick, which is Novo Nordisk, NVO on the New York Stock Exchange, 90.59 at the time, which was February last year, down to 38.28. 58% downside, total return of 56% downside. A lot of the pharmaceuticals have struggled, and Novo Nordisk hasn't really bounced back the way some of the others are beginning to. Why is that?
Well, so obviously their big drug is Wego or Ozempic is what it's known as mostly. But so I think that part of the problem, what happened with them was they being a Danish company in many ways, they're very different. They hired a lot of people through COVID because outside of COVID, when they started to grow this business, they just not have kind of right-sized the company. That's one thing. They did do a big layoff, but it was mostly in the United States, not in Denmark. The second thing I think was that Eli Lilly has been very, really kind of taken over that obesity drug business in the United States, and they're a second, which they were number one. And I think it's kind of funny because when you talk about the obesity drugs, people just talk about Ozempic. They don't talk about Mounjaro, which is Eli Lilly's drug. And the other thing was that they also had to deal with bringing the cost down. So there's a huge hit to revenue over the next couple of years because of that. One of the positives is their pill, which has been approved. You don't have to inject yourself anymore. So they have a pill, which is much better, easier for people to take. And I think that uptake on the pill has been very strong. But I think for Novo, they really need to right-size the company again. They also lay off a lot more people. They've had some, in a very in a very simple fashion. Like one of their drugs has done way better than Lilly's drug when they've come out with their data, but they didn't kind of say, okay, our drug is better. They sort of just don't kind of compete in that way. So, but I do think that there's an opportunity. This stock's fallen a lot. I think there's an opportunity that the pill will do very well for them. And Eli Lilly doesn't have a pill at the present. They will have one closer to the end of the year or the middle of the year, but it's not been approved by FDA yet. So this is a good opportunity to get more people on the pill.
Oh, so do you say they just aren't marketing it right?
Well, I think it's not that they're not marketing it right. I mean, I think that they are in some ways they're not as aggressive in marketing their drug, right? And so, there's not Ozempic and Mounjaro. There's no real difference between the two, right? Eli Lilly's been able to better market their drug, I guess, in the U.S., and that's the biggest market for this stuff, right? It's not other parts of the world. It really is the U.S. And on top of that, they had to take. And the other thing is, you have to remember that Eli Lilly is a much broad-based pharmaceutical company, where Novo is much smaller, but also has less. It's not as broad. It's not as a diversified pharma company. So, Ozempic and all these things have a much higher impact on the company on a revenue basis than it would have with Eli Lilly.
Okay, let's get to your next pick for the block then, which is MSCI on the New York Stock Exchange at 573.55 last year. That's U.S. To 553.91 today. So 3% downside, 2%. Downside. This is investment sort of support tools. Could you explain a little bit more about what they do and why you chose them?
Yeah, so MSCI it creates index products. So if you're an investment manager and you're comparing your fund to a whether it's a index product already or just a regular active manager, you compare it to an index. They create a bunch of index. The MSCI World is one of the more famous indexes, but they also do other things. So they do things like risk management around the index. They do asset allocations products and all these. So there's several products on the MSCI World they've gone into for real estate. For real estate funds, they've gone into alternative asset class indexes, et cetera. So how people measure them. So one is that from a perspective of there's only three people who do this. There's S&P 500, there's the FTSE index in London, and then there's MSCI. So if you're a money manager, you have to use one of those indexes, and MSCI is one of the biggest ones around, and you also want to have all those other resources to manage the risk of the portfolio around indexing, and especially on the indexing side or the ETF side. So that's one reason that they continue to grow, and that market continues to grow. The other aspect, I think, what would cause a stock to have some volatility over the last little while is that people felt that, people are going to create their own indexes, but money managers really can't create their own index. I mean, it would be an unfair thing. I create an index and I change that index as I go along to suit my benefit, right? So no pension fund or whoever is going to allow somebody to create their own index. It doesn't work that way. You need to use a third party that does that. So MSCI, I think it's a great business. It'll continue to grow as the asset management continues to grow. They have diversified outside of just traditional indexes into these sort of alternative asset classes, and they have a lot of other products that are much more about risk management and managing your portfolio management, risk management around portfolios. And I think people tend to, once you're benched against an index, you want to actually understand the components of that index and how, what is its effect on the portfolio that you are managing.
Got it. All right, let's take a quick break, Paul. We'll get back to more of the phone calls and emails here on Market Call when we come back. Stay tuned. Welcome back. Let's go to Mike on the line. He's in Victoria with a question today for Paul Harris. Hi, Mike.
Good morning. I'd like to ask Paul about his long-term outlook on TELUS. And at almost 9% this morning, does he think that dividend is sustainable? And secondly, if the dividend was cut, what does he think that would do to the stock price? Would those people that are holding it for dividends would leave and the stock price would go down, or do you think that because it makes the company a little more nimble, it would have cash to respond to things, maybe in acquisitions or capital expenditures and so it might go up? So I'd like Paul's thoughts on that. Thank you.
Okay, thank you for that question. Dividend, Paul, here at 8.9%. Stock price is $18.78. What do you think?
Well, so a couple of things. I mean, they did come out and say they're not going to increase their dividend anymore. So, which is, I think, was the wrong thing to do. I think they should have, given the way the stock price was, it would have been better to cut their dividend, like Bell did, and bring it down to a more reasonable level. I take your I think the initial reaction when somebody cuts their dividend like that, depending on where the stock price is, there's a fall in the stock price. But the gentleman is absolutely right. I mean, one of the great things about cutting the dividend to a more reasonable level, let's say 4% or something like that, in line with banks, is that you can use that money to do other things, either pay down debt. You can buy back your shares. You can use it for acquisition. So I think there's a lot of things you can do, and I think the issue that, and this may change because obviously they have a new CEO coming in. The gentleman who used to run CIBC is the new CEO. Victor Dodik is the new CEO of TELUS, and so he may kind of make some of these bigger decisions to change the way they think about it. But I always feel that when you get to these kind of levels on dividend yield, it's to me unsustainable. And I think it's in a world we're living in, I don't think you need to have a 9% or almost a 9% dividend yield and just say you're not going to increase the dividend anymore. At the where the stock price is, I think you may take a small hit short term, but longer term you can restructure how you spend that money and what you should be spending it on, right? So I think it's a better thing to do. I think it's really hard for boards to make those decisions though. But you have a new CEO, maybe that's going to change all those things in the next little while.
Okay, so there might be some change quickly to come. Let's quickly get to Philip. He's in Toronto. Hi, Philip.
Hello. Thank you for taking my call. My question is on Kraft Heinz, whether he thinks it's dead money or there's a future in keeping it. And I'd like to know his opinion.
Okay, thank you for the question. Let's talk about Kraft Heinz, more of a consumer. Would you call it a staples company? Where would you put this one?
Yeah, I mean, I wouldn't. Yeah, I guess consumer products like macaroni and cheese and stuff like that. So I guess maybe if we were in a recession, you want to buy mac and cheese. But I think the problem with this company is that they took on a lot of debt when they kind of merged the company. It's when you look at their balance sheet, they still have lots of debt on their balance sheet. Their returns on capital and all those things have just been terrible. I think Warren Buffett, as he's still running the company, kind of has always said that this was sort of one of the big mistakes he made, right? So I think there's better places to put your money. That's all, right? So I think there's no reason to own Kraft Heinz if there are better businesses that are run better, that have better, don't have as much debt on their balance sheet. And I think also a lot of the products, you have to remember, we talked about Ozempic and a lot of these kind of products are really having a hard time growing, right? Because people stop eating this kind of food.
Yeah, processed food. Okay, let's take a quick break. We'll get to more phone calls when we come back. Stay tuned. Welcome back. Let's go straight to an email from Sunny in Brampton, Ontario. Paulie wants to know about Constellation software. He picked some up before. He wants to know whether he should pick some more up.
Okay. So Constellation obviously has been under a lot of pressure of late, for many reasons. One, the longtime CEO is left, and so that's one of the things. And also, I think there's been this talk about sort of AI kind of taking over, creating their software a lot faster. And taking over some of the places where they generate returns from. So a couple of things. One, I think Constellation is in a very different thing. It's not a software that's sort of ubiquitous to a company like they tend to do software for a golf course or something like that. So in that respect, somebody could actually get Claude, Cowork, or whatever it's called, to write the software for that company very easily, I think. And that's part of the problem why Constellation is having trouble. I think the issue for Constellation is what are you willing to pay for this company really is what you have to think about, because, people were paying 30, 40 times earnings for this company for a long time because they were able to capitalize on buying businesses, right? So in a world that's very different for them, yes, they may be able to buy these businesses cheaper, but what do you want to pay for Constellation? And I think that's the big issue. And I think it's very difficult to figure that out. But I think there's going to be volatility in the stock on an ongoing basis. So, but I think it'll still exist, but you may want to be able to buy it cheaper. That's all.
Okay, we're going to leave it there. We will take a quick break. New top picks from Paul when we come back. Join us Monday for Market Call. Bruce Campbell will be on the show, President and Portfolio Manager, Stonecastle Investment Management. They'll take your questions on Canadian stocks. Let's get to the new top picks from Paul Harris. First Service is where we start. This is a property management company. Paul, what do you like about them?
Yeah, so it's a property management company, but they also have a services business. So people would know California Closets or Paul Davis is another franchise of theirs. So what I like about this company, it's a great Canadian business. They've kind of grown through in the United States, through making small acquisitions, bolt-on acquisitions. But it's a very fragmented business, so they continue to grow there. This is a company that's not only compounded organically, but also through these acquisitions. And I think that's, you can continue to see them continue to do that. I think that's, got a great business in the United States and this is where they continue to grow a great deal, I think. And so, it's a very simple business. There's a lot of mom and pops in there which they can constantly buy and take over some of these services businesses, which integrate quite well into some of the other things that they're doing. So it's also there's a bit of an annuity to it, because once you sign a contract for people for them to take care of your property, you don't actually change that every year. You tend to do that for several years, and there's an inflation increasing clause in that as well. So you get this sort of very nice business that can grow nicely, and they are very good with acquisitions. So I think that's really helped them a lot.
Got it. Okay, let's get to your next pick, which is Microsoft here, MSFT on the NASDAQ. All of these tech stocks have been beaten down. You like Microsoft moving forward. Why?
Well, obviously Microsoft has many different businesses, from kind of, Office, which people know about, to the cloud business, to business intelligence. They make computers as well. I think part of the reason Microsoft was, is their spend on AI, which everybody got worried about, which continues to do, but they have lots of free cash flow to manage that. They've got the best debt rating in the world. I think they're the only company that's AAA these days. This is a company that continues to have very high returns on invested capital, very high returns, gross margins and operating margins. But I think one of the problems I have is that people go, oh, well, somebody's going to come along and get rid of Office. Well, if you're a company that makes widgets, and you want to use AI, are you going to use AI to make your widget better? Or are you going to rip out, Office, which everybody knows how to use and is very productive, and go design your own kind of Office system, right? I don't think people are going to do that. I think people will continue to use these products. They may use slightly less of them because they have less people there, but that's pretty normal. But I think that the issue is that Microsoft will continue to grow. I mean, I think the big risk is how much they spend on AI on these data centers, which they become less like they tend to own more of these assets, which I think is a problem if we don't see the kind of return on those data centers or return on the capital that they're spending. And it's very hard to tell right now, but I think Microsoft, is a leader in this. They deal with a lot of large institutions, and so they're going to benefit from the growth in AI, which I think is going to be substantial.
Yeah, and I think some people are underestimating how these companies will use AI to help their own product, their software products, as opposed to developing a complete new system somewhere outside. Okay, let's get to your last pick, Adobe, which for the same reasons has been very beaten down, but you still have confidence here. Why?
Well, so I think, people feel that Adobe, so two things happened with Adobe. One, they kind of, they were going to buy a company called Figma, which is a public company now, but that got turned down by the Biden administration, or they didn't think they would be able to get it approved. I think in this environment, they would have been able to do that, but that's one thing. But the other thing I think with Adobe is that people have this very similar thing that, it's going to be eaten up by AI. But this is a company that continues to grow its revenue. They've been buying back their shares. They've grown their revenue by 10% of their top line. I mean, it's trading at a very low multiple. It's a product that everybody uses, that are very familiar with, and continue to use it. And I think one of the problems that Adobe did was that they actually talked about AI too much in their business, as opposed to slowly letting it, letting their AI products show up in their business. And so people have this very high expectations of how it's going to change Adobe's business and how people are using it. So I think that's what's caused the stock to fall a lot, and that's a good buy here.
Okay. Paul, got to leave it there. Out of time with you. Thanks as always, and have a good weekend.
My pleasure.
Thank you for joining us today in Market Call. We'll see you back here on Monday.